I don't know if Dennis Gartman has a Tesla, but we're going to bring him in because, Dennis, we saw this. The bulls may be breaking out the champagne on Wall Street, but there is the survey. I don't know if you saw this. It makes you wonder. There are a record number of fund managers making the prediction that the global economy is on its last legs. Comes out of Bank of America Merrill Lynch. It's got a monthly survey of investment managers, and these are the folks who run, what, about $684 billion worth of assets. More than a third of them, Dennis, are expecting a slowdown next year. I believe that's the worst outlook since the financial crisis in 2008. Come in right now with your thought, please. It's too much to say for me, too broad to say we're in the later stages of the growth cycle, and that's what these guys are saying. Cut to the chase. Where are we? Bull, bear, on the precipice of a bear. Really narrow it down for us.
We are in the very later stages of an economic upturn. There's no question about it. The Fed is going to tighten probably too much, take the yield curve to an inversion. We hear that talk all the time, but that's what the Fed intends to do or will end up doing. I think we'll be in a slowdown of some sort by sometime late next year, maybe a little bit earlier than that. And until then, the economy is still very strong for now, but it shall weaken next year. And stock markets go down before economies turn down. Stock markets go up before economies turn up. I think we've seen the highs in stocks in global terms. We may be seeing the highs in stocks here in the United States, and I think it's wise, if you are aggressively long, to be demonstrably less long. I think if you're not long, I think it's time to go to the sidelines. I think we've started a bear market globally, and the United States has been able to offset that global bear market by moving higher, but I think that's over.
Dennis, okay, so are we... I'm going to push you here. As you said, that the two bifurcate, the economy, stock market, two different things. I saw that the S&P 500, 250 of the names are now down, as of yesterday, 20%. Another 100 or so are down something like 40%. Does that mean that we're in a bear market and nobody really realizes it yet?
Liz, I think we're in a bear market. Nobody really realizes it yet. There's a great chart that you just put up right here. How can we have 484 points
in gains for the Dow right now and be in a bear market?
Well, you lost 2,000 Dow points last week, so a bounce of 480 points is really not that terribly consequential. And what's really important, what I'm going to pay attention to this afternoon, is what's the volume like on the upside. If the volume is less than the volume
it's 9% below the 1 month average, and last week it was 30 to 36% above the 1 month average.
And that tells you all that you really need to know. Volume should follow the trend, and if volume is down on an up day like this, and when volume expanded dramatically last week on the downside, that has to tell you, be very careful, be less involved, use this strength to become less involved, use this strength to sell into. I think that's the wise choice or wise course of action for the next several weeks and certainly for the next several days.
Dennis, Charlie Gasparino here.
Hey, Charlie.
How are you? Say hello to your daughter for me. Good kid.
I shall.
The bull case for the market is that the tax cuts, the massive corporate tax cuts, aren't fully factored into the economy, at least, maybe the market, but the economy, that the growth prospect of companies will expand even greater in next year because of those tax cuts are enough. The supply side impact hasn't yet kicked in. How do you address that? Because that supply side impacts usually take 6 months, a year to fully factor into the economy.
And Charlie, don't stock markets anticipate and discount that sort of activity. Everybody knows that the tax cuts have gone into effect. There's no new news to that effect. We may get new tax cuts, which I doubt. We need that to keep these things going higher. And to me, what's most important of all is the fuel for the stock market. The adjusted monetary base has been declining now since 2015. The Fed had gone out of its way to supply fuel to the system. Now it's taking that fuel away.
So you're saying the reverse of QE. You're talking about the reverse of QE. Forget about Fed funds rate. You're talking about on the long end, which could really lead to much higher interest rates.
Exactly. That's what I'm very concerned about. We need to roll off that huge increase in the adjusted base.
Okay, but
we went from 800 billion.
Right.
Yes, go ahead.
I get
I'm sorry.
That. Can we just end on how do you invest? Surely there's always a trade, is there not? So with your perspective, how and where do you put the money?
I think you put it in the bond. There are a lot of bond funds that are listed that have very great liquidity, that pay 6 and 7 and 8%. They pay the dividends on a monthly basis. I think that's the closest thing to cash, the best place for people to go to, and I think that's where you should hide for the next several months.
I just got news from Charlie Brady. I'm going to whisper this. That volume I said was 9% below the one-month average. In this last half hour, it is now 15% below the one-month average.
So this means,
that's,
I guess,
that's not a good sign.
The translation, Dennis, is no conviction on the upside, you're saying.
Charlie, that's exactly right. There's no conviction on the upside. There was conviction last week on the downside. Yes, indeed, the Dow's up 500 points today, but again, it was down 2,000 points last week on monstrously larger volume.
You're just
Very important
you're
to
just a
understand
perma bear. That's what they say on Twitter.
No, I'm not. No, I'm not.